Welcome to the big interview on the January 16th edition of Money Life. And this one, fun and a little bit different because I'm joined right now by Ryan Kimmel. He is a strategist on the macro allocation team at DoubleLine. If you're not familiar with the firm, well, Jeff Gundlach, who is founder of the firm, is known as one of the best bond fund managers in history. But what you may not know about the firm is that they do really good market research, have some fabulous think pieces. You can find them at doubleline.com. But we're talking about one in particular, and we have it, by the way, linked up in our show notes and on our guest page where you find Ryan. This particular piece is rethinking economic signals beyond the BLS business. And it's looking at the challenges that are being faced by the Bureau of Labor Statistics in producing the monthly employment figures when we've got declining survey numbers, we've got political pressure, and a whole bunch of other things. And you know, if you listen to the show, we want to know if the numbers are right. So again, if you want to check it out for yourself, doubleline.com or follow the link. But right now, we'll talk about it. Ryan Kimmel, welcome to Money Life.
Hi, Chuck. Thanks for having me.
I love this paper because it is something that keeps coming up. But let's start with kind of the 800-pound gorilla when it comes to BLS numbers and the rest, which is they're not supposed to be politicized, but at least for a while they were, or maybe they still are being politicized. So is this a problem that is about political pressure, or is this a problem about the economics of keeping all the economic statistics?
Yeah, it's it's tough to make it a political argument, but data quality issues have been a theme that we at DoubleLine have been highlighting for a number of years now, even predating the COVID pandemic. And what we were really noticing is that when you're looking at economic data, charts and whatnot, what you're seeing on that chart from a historical perspective isn't really what you were witnessing on a real-time basis, and what was actually impacting markets at the time of release. And one thing that we were noticing is that post-COVID, the data quality issues were actually getting quite a bit worse. You were seeing lower response rates across many of the official kind of publications and releases, particularly from the Bureau of Labor Statistics. And then what really was like the catalyst for me to write this paper the summer of last year was it was midsummer. The FOMC just had their late July meeting, and the commentary from the Fed was pretty hawkish. They were looking at relatively strong employment numbers from the June number, and the market started to price out rate cuts for 2025. And the Fed meets on Wednesdays. We happen to get the July payrolls report like 2 days later on the following Friday. And what you saw were like massive downward revisions to the previous 2 months, like 258,000 jobs less than were originally reported. And this led to a significant repricing of Fed policy rate expectations for 2025. I think like the 2-year yield dropped like 25 to 30 basis points in like the minutes following the 8:30 Eastern release, and it kind of like laid the groundwork for the Fed to start basically talking up Fed cuts for the remainder of the year, which were actually realized with 3 25 basis point rate cuts for the remainder of the year. And it just like really draws into question like the Fed, what would the Fed have done if they had like the actual data on hand? I'm sure they wouldn't have been so hawkish in their commentary, and that would have led to far less of a market dislocation in the days to come.
Is the bottom line of that when the Fed tells you they're data dependent, you, given your role and what you know, are thinking, yeah, but you're dependent on bad data?
Yeah, I mean, they're limited like we are. I don't think they have any like sort of crystal ball or anything that is materially different than what we have access to it from a data perspective. So lots of times when they're making policy decisions, they are in a way looking in the rearview mirror, and they have to be cognizant that the data that they have in hand might change. And I think they're kind of waking up to that. I mean, you heard Powell, I think it was at the December FOMC meeting. He was basically saying, like, it does look like, payrolls are being overstated by around 60,000 jobs per month. If, as you know, every, uh, every year we get like annual benchmark revisions, where they basically like restate the data. They backdate it to March of the preceding year. We get preliminary estimates of these annual benchmark revisions in early September, and then we get a finalized benchmark revision in February, which we'll get in a couple weeks. And basically, what we're seeing, at least based on the preliminary revisions, like that employment was overstated by over 900,000 jobs. So, in 2025, we were running on average like 60,000 jobs per month, at least in the private sector. So when you take out maybe that adjustment that for overcounting, we're kind of running at near flat job growth.
There are maybe the political side of this is you have to have revisions. The revisions make sense when you understand what's going on, but they sound bad, they feel bad, et cetera. And any side, if they're revised in a way that doesn't make the case you want them to make, it's obviously somebody else is doing something nefarious.
Mm-hmm.
But there's nothing really nefarious in the revisions. It's just the problem with the data. And the worse the data is, the more the revisions become important, but also the more they become dramatic, right?
Yeah. Well, the issue is, it's like, since we have lower response rates, they have to rely on imputed data. That's another word for saying they just have to rely on models for their assumptions. And it just makes you much more sensitive to model miscalculations. And so what we're seeing is that the numbers are just becoming more heavily more dependent on these model assumptions, and they're too aggressive. They're too just optimistic on and job creation, and they're just consistently having to revise down that data. I mean, one thing it is interesting is like the response rates are so you get like an initial jobs report, then you get secondary and tertiary releases, and then you just get like a final revision on annualized basis. The response rates are very low on that initial release, but they tend to improve quite dramatically on the second and third. So some of the discussion I've heard out there is like maybe just delaying the releases until you have more data, you've collected more data, and so you're less relying on these model imputations, which it that does make some sense to me. I mean, if you have bad data, I think that could actually be more harmful than good.
Is the quality of the data in any way contributing to something that we have seen, which is there are plenty of things that experienced market observers would expect to happen. You're going to put in a bunch of tariffs. This is how we'd expect the market to react. You're going to have an inverted yield curve. This is what we think is going to happen with the economy. I mean, we have the most forecasted economy that's never occurred, the most forecasted recession that has never occurred over the last several years. And the market has had 3 fabulous years. Plenty of people think it's about to have a 4th. And yet, there's all kinds of people who at one point were calling for recession, and now they've just given up because they don't seem to want to be wrong. But is some of the wrong forecasting or whatever, we think this should happen, the result of the fact that the numbers aren't giving us a clear picture?
Yeah, I think when you're, every cycle is different. And I'd say this post COVID expansion has been incredibly different than previous economic expansions. And the recession that many people were forecasting, including us. I mean, we were in the recession camp in 2024 and in 2025 when we were looking at a massively inverted in yield curve, and obviously we haven't seen a recession yet, but there's this concept of like rolling recessions where, sure, in aggregate, let's just call it like GDP hasn't really declined into negative readings, or the NBER, the National Bureau of Economic Research. They're the group, the entity that's responsible for classifying economic inflection points and including recessions. You know, based on their metrics, you haven't seen a recession per their definition. But what I'd say is like in a world where job growth has been very slow. We're running near zero employment growth per year. The concentration of that employment growth is limited to like one sector. In fact, if you look at like 2025, private payroll growth, like over 90% of that is in the healthcare sector, which is not really I'd call it like a cyclically sensitive sector. If you look at the more like cyclically sensitive sectors in, like professional services, things like that, we've actually seen job declines last year. So it's tough when looking at things in like an aggregate, and I feel like we're always trying to kind of pigeonhole the economy into this like aggregate kind of metric. But we're seeing just like these rolling areas of weakness. The manufacturing sector that has been in decline. The employment side, like employment in the manufacturing sector, has been running negative for quite some time now. If you look at some like the survey data from ISM, it's been in contraction for the better part of like 3 or 4 years now, while the services has been in expansion. Small business, if you break down like employment growth by large, medium, and small businesses, like small businesses have seen job declines, while that's just been purely offset by employment growth in large businesses. And it kind of plays into, I'm sure other guests that you've had on have talked about this like K-shaped recovery, and you're just seeing the top decile of income earners, and larger firms are doing well, fueled by positive impacts from the wealth effect, while the lower decile have really been hurting and have been trying to tap credit to fuel consumption. And when it comes to like trying to identify for us like economic inflection points, you really have to look at these lower income cohorts, because they're the marginal consumer. They're the ones that are shifting on and off their consumption, dependent on which kind of like economic regime you are in.
Is it harder to read them? I mean, the flip side of it is here we are talking about BLS statistics, but if you are looking at those kinds of consumers, we probably have more data than we've ever had, because we've got Federal Reserve data, we've got, credit card and spending data, we've got any number of different analyses. Is it on some of that stuff that, okay, great, we've got the stuff we've relied on, not as good. We've got all this other stuff that maybe we're trying to figure out how to read it or what the issue is. I mean, is it paralysis by overanalysis? What are we talking about?
Yeah, I mean, as you said, we've never had so much data. Both, there's a ton of new kind of private sources out there. For us at DoubleLine, I'm part of the macro asset allocation team, and it's our responsibility to kind of develop and cultivate the kind of the key macro themes that are driving the top-down asset allocation decisions across our strategies. And when we're trying to develop these themes, we're taking we're building like a mosaic, as I labeled in our the paper, of economic indicators, both from official sources and private sources, and trying to kind of put these pieces together to build a theme. And what's interesting is like you're seeing job growth slowing pretty significantly from the BLS data, the official data, but it's also lining up with data from ADP and other sources like Revelio. And when you look at like kind of like 3 month, you might see some discrepancies between these data sets on like a month to month basis. But when you run a little bit longer time frames, like 3 month averages or 6 month averages, they actually start to line up pretty well, like with correlations above zero 0.8. And they're all kind of signaling the same thing with aggregate aggregate employment slowing. But, and I'd say but, key caveat, it's not falling off a cliff.
Okay, so in limited time, because we're nearing the end of our time together, my audience, I think, would kill me if I didn't say, okay, with all the data that we're talking about, what's your forecast for whether or not we're going to wind up with a recession and when it's going to wind up being here? I mean, how do you read this data to give us some measure of here's where we are now and where we're headed?
Yeah, yep. The key question. And, I would say that like right now, consensus forecast, if you just like look at Bloomberg consensus forecast probability of recession over the next 12 months, that's at 30%. My read is like the street is probably lower than that. I think that Bloomberg consensus number is a bit stale. I think the street would be somewhere lower, probably between like 15 to 30%. We would take the over on that. And that is just on the view that we're seeing the slowdown in job growth, as I've said a bunch of times, several times on this call already. And we haven't really seen the full impact of tariffs. I know a lot of people have already fully discounted tariffs as a negative impact on the economy. But, if you look at like realized effective tariff rates over the last kind of three months, we're running around like 11 percentage points of an effective tariff rate. I think that might start to percolate through the economy. So far, and it's relatively early innings in this tariff episode, but like corporations have been able to absorb a lot of the tariff costs into margins, which has been great. It hasn't led to higher inflation, but the longer we go into this tariff episode, corporations can be faced with either passing these costs on to the consumer, which I'm not sure the consumer can absorb these price hikes, given that we've already had to endure 25% cumulative inflation since 2020, or they're going to eventually have to start laying folks off. And for us, that's the key data point to look at. Are we going to see layoffs start to increase? So once we start to see that, then we would make the recession call our base case. Like right now, I'd put the recession probability somewhere between like 30 to 50%. I think there's like a 50% chance we'll just kind of continue to muddle through. But if we start to see initial jobless claims start to move higher, which they're actually moving lower. If you look at the data we had this morning,
then if you trust the data,
that's true. And I mean, this is a data quality episode. So, initial jobless claims, they have a lot of like residual seasonality baked into them that they haven't really accounted for. The data we're looking at currently still has a lot of distortions from the holiday period. So again, you got to take everything with a grain of salt and look at it kind of with other metrics. But we're not really seeing any sort of, even looking at other indicators of like a material pickup in layoffs.
Ryan, it's really interesting, the whole idea, and then what it does for the forecast. I appreciate your time. I look forward to chatting with you again down the line.
Thanks, Chuck. Been great.